Inflation is too high. Raise interest rates. People borrow less, people spend less, inflation comes down, problem solved. That's what school taught us. But it is not that easy in the real world. Because Australia's inflation problem isn't coming entirely from Australians spending too much money. Part of it is coming from a supply shock thousands of kilometers away. The conflict in the Middle East has pushed up energy and other input costs. The Reserve Bank itself says those pressures are contributing to Australia's inflation problem, and interest rates cannot produce another barrel of oil. They cannot fix a disrupted supply chain. What higher rates can do is make Australians borrow less and spend less somewhere else. And one of the first places where that pressure is showing up is housing. The RBA has raised rates 3 times this year, taking the cash rate to 4.35%. Those increases didn't create the housing slowdown by themselves, but they added another powerful brake. House prices have retreated from their March peak. Australia's biggest banks are also reporting double-digit declines in new mortgage applications. New loans to property investors fell more than 10% in the June quarter. In New South Wales, they fell more than 14%. From the RBA's perspective, some of this is actually good news. Monetary policy is working. People borrow less. Housing demand cools. Households have less money available to spend elsewhere. But Australia is discovering the difference between reducing demand and reducing inflation. If inflation comes from people buying too much, weaker demand attacks the problem directly. But if part of the inflation comes from energy and other supply costs, higher interest rates cannot remove the original cause. They can only weaken other parts of the economy enough to compensate. Housing is one of those parts. And that matters because housing sits at the center of Australia's household wealth and banking system. Commonwealth Bank controls roughly a quarter of the mortgage market. Westpac is another giant, followed by NAB and ANZ. Then there is Macquarie. Macquarie has only around 7% of the mortgage market, but its mortgage book has been growing much faster than the traditional Big Four. So the banks aren't simply facing fewer new borrowers. They're fighting harder over the borrowers who remain. Imagine 5 restaurants on the same street. When the number of customers keeps growing, everyone can do well. But when fewer customers show up, one restaurant's growth increasingly comes at somebody else's expense. That's the battle developing in Australian mortgages. Macquarie can keep growing by taking market share. But that forces the Big Four to choose between accepting slower growth or competing harder on price. And that's why Australia's banks don't need a housing crash to feel pain. They don't need mass defaults. Slower mortgage growth combined with intense competition can squeeze profitability all by itself. This is also why we shouldn't focus only on house prices. Prices tell us what housing is worth today. Loan applications tell us where demand may be going tomorrow. Some of that weakness is simple arithmetic. Higher interest rates mean the same household income supports a smaller loan. People simply cannot borrow as much as they could before. But psychology matters too. For years, Australians could reasonably assume that property would become substantially more valuable over time. That creates urgency. If you believe a house will be much more expensive 5 years from now, waiting has a cost. But when financing becomes more expensive while prices are falling, the calculation changes. Why buy today if the property might be cheaper later? That doesn't mean Australia is heading toward a housing crash. There are powerful forces supporting the market. Population growth remains strong. Housing supply is constrained. The labor market has remained relatively resilient. Those are serious buffers against a deep collapse. And that's why the more interesting risk may not be a crash at all. Imagine house prices simply remain weak. Mortgage applications stay subdued. Property investors remain cautious. Banks fight harder over fewer new borrowers. Consumers become more conservative. But unemployment doesn't explode and the financial system remains stable. Then, what forces the RBA to rescue housing? Possibly nothing. And that's where inflation becomes crucial. The RBA still sees inflation risks tilted to the upside. So imagine housing and household demand continue weakening while energy and other external costs keep inflation uncomfortable. Normally, weaker demand would eventually create room for lower rates. But if inflation remains elevated, that room becomes much smaller. The RBA then faces an uncomfortable choice. Keep policy restrictive and tolerate more weakness in housing and household demand, or provide relief before inflation is fully under control. Neither option is attractive, and that's the part the textbook model leaves out. Monetary policy is powerful, but it is blunt. The RBA cannot raise interest rates on imported energy. It cannot target an oil producer overseas. It changes the price of money across Australia. So, when part of the inflation comes from outside Australia, the adjustment has to happen somewhere else. Right now, housing is absorbing part of that adjustment. For investors, watch three things. Watch new mortgage demand because it can tell us more about where housing is heading than today's prices. Watch bank margins because Macquarie's expansion could make a slowing mortgage market increasingly painful for the Big Four. And most importantly, watch inflation because the difficult scenario isn't a sudden Australian housing crash. It's housing, borrowing, and household demand continuing to weaken while inflation remains too high for the RBA to provide much relief. Inflation is too high. Raise interest rates. Reduce demand. Bring inflation down. That's what school taught us. But what happens when the inflation you're fighting wasn't entirely created by the people whose spending you're trying to suppress? Australia may be finding out. The RBA can control the medicine. It cannot perfectly control where the effects show up. If you enjoy global macro stories that go beyond the headline and explain what they mean for markets, economies, and your money, subscribe to Global Notes by JP. Because sometimes the biggest economic problem isn't that the medicine doesn't work. It's that it works somewhere you didn't want it to.